Welcome to the Boiler Room Trading Money Talks podcast. If you'd like to be our next guest, follow the first link in the description of this video and add yourself to our podcast guest list. So today we're discussing how the free commission movement in stock trading is really helping traders. See, before we went to a free commission sort of standard, it would seem that a lot of traders would jump into a position pretty much at full size, and then they never had any more capital to really work with to manage their trades. See, something common you hear in the market is always manage your trade, manage the risk, manage your position, right? You hear that a lot of times. You hear a lot of hedge funds talk it, big investments, even smaller guys, like myself. We always say you got to manage the trade. You have to manage the risk, manage the position. And the problem before was a trader didn't want to spend money on commission. I mean, we still don't to a certain extent, and you can ask many traders. I mean, yeah, paying commissions does suck. And we could discuss that, later in other podcasts of why we pay commissions to certain brokers. But at the end of the day, nobody really likes paying, additional money to do anything. So before, when you took a position, you'd have to pay commission on every single trade, in and out, which could eat away at your profits. So that would keep traders from wanting to maybe take 100 shares long and then add 100 shares long and then add 100 shares long. And then as the price increases, sell 150 shares, sell 100 shares, sell 50 shares. Because that right there would be commission on the first buy, commission on the second buy, commission on the third buy, commission on the first sale, second sale, and third sale. Those commissions will add up. Well, now that we're kind of going to a free commission market, I mean, you can buy 5 shares, 10 shares, 20 shares, 100 shares, 100 shares, 100 shares, 100 shares, and they pay no commission. You'll pay like small ECN fees and routing fees and things like that, but they're so minuscule you probably hardly even notice them at the end of the day. So that's the really nice thing about the market that we've kind of shifted into of this free commission, because it allows traders to truly build in a position and scale out of a position. And that's the nice thing. This is allowing traders to be more efficient and actually be more accurate with their trading. Because a part of why trading is so hard to master is because when you jump into a position, you're seeing that P&L or your dollar go up and down so rapidly from a red to green, winning, losing. You get a little emotional and you might want to take your trade off. And if you were to actually start with a smaller size or smaller amount of capital invested, your P&L or your profit loss won't be fluctuating as fast, and it's going to allow you as an individual and as a trader to rationalize the situation you're in better than if you had a ton of money on the line. Because the more money you have, the faster and the wider the fluctuation will be on your profit to loss or win or losing so fast and so rapidly that it becomes harder to manage your emotion and to rationalize and think logically about the situation you're involved in. So in the free commission market, for example, a trader has $10,000 of capital to work with. He may now invest $1,000, kind of limp in. So say he wants to use $5,000. Let's just say he had a $10,000 account and he wanted to use 50% of his capital for whatever reason, just for simple purposes of this podcast. So he's got a $5,000 amount to work with, but rather than going in $5,000 all at once, he's going to limp in. He's going to get a feel for the stock. So rather than jumping in right away and thinking that he's going to be right away, he can kind of get his feet wet and test the waters. Same as you would do with any rational decision making. Before you jump in on anything, you would naturally kind of get a feel for it. Same way you do when you go swimming and you dip your foot in the water to see if it's cold. You're testing the temperature before you just go all into a freezing ice cold pool and then regret it a couple seconds later. So if we have a $5,000 total capital amount to work with, maybe we go in 1,000 and say we just pick up 100 shares. And now we're in, and maybe we go up and maybe we go down, but you're allowing yourself to get in control of your position, understand the way the stock is moving, and kind of grow a relationship with that position without having such an emotional attachment. And then, as you maybe sat in it for a couple minutes, it didn't go your favor right away, but you're starting to feel more of those buyers coming in. And every time you see a red candle come and it starts to sell down, it's kind of weak. It's not really feeling as aggressive. You can kind of feel maybe the slowing pressure or the selling pressure is slowing down. So now you add another 100 shares. You might have just averaged down your price and actually now have a better overall average. And you're not really averaging down a loser because you're still working in your initial position. It's not like you made a position, took a really big loss, and now you're trying to average down to turn it into a winner because you've been losing. No, you started with the 100 shares. That was $1,000 of the capital you were willing to work with. And now that you've been invested for a second, you're starting to get comfortable with it. You're starting to understand it a little bit more. You've built that relationship up. You're understanding the buyers, the sellers, the movement, and the flow. You believe that it's smarter to take another 100 shares at this lower price. You average down your position. You're managing that position and you're managing that risk. And you're not paying any commission. That's really the bonus here. And then as things look a little bit better, maybe you get into 300, then 400, then 500 shares, and you've built up your 5,000 share position, your $5,000 position, just as the stock is starting to pull up and it's starting to bounce. You've allowed yourself to get a taste and a feel of that whole transitional movement of momentum, right? Because stocks come down, a lot of times they'll slow down on the selling and then they'll go through a bounce, right? How often, right? Comment on this video because I'm there still quite often, and that's why I like to limp in every once in a while. But comment down below. Have you guys ever jumped into a position and you're wrong initially, but then you're right just a few minutes later, and maybe you've already cut off your position? Or just how often do you jump into a position and you're initially wrong, and then a little bit later you end up being right? And that's kind of that beauty of sizing in small or doing what I call limping in. Because if you kind of limp in with just a little bit of your capital, it's not going to blow your account. It's not going to crush you. So that if you are most likely wrong, which you will most likely be wrong because it's extremely hard to time the market perfectly every time. So a lot of times you might jump the gun a little early on a trade. And if you jump the gun too early on a trade with all of your capital, then you're leaving yourself with no way of managing your trade. You're done for. It's a do or die situation. And that's why it's so important for traders to understand, whether new or old, and always keep it in the forefront of their mind, the big word risk, right? Oftentimes as traders, we fall victim to the profit making, the money making, the big green dollar signs, and we kind of push that four-letter word risk aside. But if you keep it in the forefront of your mind at all times, you will start to become a better, more efficient trader. And the free commission movement is just enabling that even more for you. It's making it easier for you to become a smarter, more risk-oriented trader, because now you're not dishing out as much money in commission. Now you can sort of limp into a position. You can test the waters without having to pay. It's like a free trial. You're literally getting a free trial to the market every time you open a position. Before, you had to pay money. Now it's like, let me try this out. Okay, 100 shares, boom. Just a little free trial. What am I going to lose? Like 50 cents, a dollar, maybe $5, right? I spend that on coffee every day, but at least now I can get that 100 shares in, maybe that $1,000 of capital, and I can just test the waters here, see what it's like. Do I even like the way this stock moves? I thought I did. Maybe I didn't. How often does that happen? You kind of jump into a position like, this actually kind of sucks, and I really wish I didn't come. It's kind of like being invited to a party that you know you don't want to go, but then you go because you're trying to make your friend feel better, and then when you get there, you're like, damn, this was a terrible decision. I should have just said no, right? We all do that every once in a while, and it happens to us traders too, all the time in the market. So that's the nice thing about this free commission, is it allows you to limp in, and now you have more firing power. Before, when you just jump in and put all your $5,000 on the line, you have no more firing power. You have no more capital to work with. Your capital is your leverage, right? Just like you see in the movies, right? In the mob movies, right? When you got the big gangs, right? They always try to get leverage over their competitors because that gives them control, power, and manipulation and sway. They now kind of have control to make movements and moves that they would like. Same thing for you now. Free commission, you can get in 100 shares, $1,000 out of the 5,000, test the waters. If it comes down a little bit more, you can buy a little bit more. And if you're thinking, oh, Connor, that's averaging down, you got to think like an investor. Just because you're a trader doesn't make you an investor. You're still an investor at heart, but you're just using short-term speculative moves to make quicker income, right? So if you bought stock ABC at price of $1, thinking it was going to go higher, but then it doesn't, shouldn't you want to buy it if it's at 95 cents? Because if you just liked it at $1 as an investment, then why wouldn't you like it at 95 cents as an investment? You're just getting it at a better price than you were already paying. So you still have to keep the mindset of an investor at heart, even while you're trading. And this free commission can allow you to get in a little bit and then manage that position all the way up until it's ready to go, right? And that can allow you to average down your positions with little capital, right? You start little, you size in by a little, you'll move your average down by a little, and you'll start managing risks in trades. And that's how, when you have a losing trade, they end up not being that bad. Because you may have started high, and as it came down, you were negative, maybe $50. And then as you bought maybe another 100 shares at a low point and it bounced up, you kind of went back to a green position, right? And then as it comes down, maybe you're a little bit red, and you add in a little bit more, and then it goes back up. Now you're green again. And then it gets to a point where you're like, you know what? Either this is going to go now, or I'm probably altogether wrong. And then as you finally decided you're wrong, you just kind of take it off. And at that point, you've kind of managed the position so well that you're really not even losing. You were just wrong, but you didn't take a big hit. Versus if you started with all your capital initially, you'd be down really big through those swings, and it might make you cut it off on a low. Or if it doesn't fully work out and maybe the stock goes completely the opposite way, now you're taking a really big hit, an unnecessary hit. And this, ladies and gentlemen, is really the beauty of the free commission standard we're seeing, is it truly allows you to start managing positions rather than taking do or die positions, because that is the most toxic thing I think that initially happens to traders when you involve yourself into the market starting out, is you take these really big positions, you over leverage too much, and you end up getting hit too hard. Granted, when you over leverage or take those really big positions and they do work out and you hit a monster winner, it feels amazing, but it's not a logical long-term approach for success. You can have and you can take really, really big positions, but it has to be in relation to your account and properly risk-oriented in regards to the amount of capital you have. I can take a 20,000 share position on something if I have an account that can allow for that 20,000 share position to still be within the responsible means and completely risk-oriented. Okay? If it's jumping outside of that, into the kind of the danger zone, you can't go there. It's very, very toxic, and long-term success probably not going to happen at that rate. So I hope you guys like this podcast. Let me know what you guys think in the description below. As always, hit the thumbs up button, share the podcast around so we can enlighten more traders around the YouTube network. Everybody, thank you guys for tuning in, and I'll see you guys on the next one.